What's up, traders? Good morning. Wow, it is really bright in here. I can barely see the screen, but I hope everyone is doing well today. Slight technical difficulties, so we switch it up a little here. And as you recall, yesterday I was talking about weak bidding in the market, a false rally, right, and looking for potential downside move, right? Same thing. Yesterday, as the day shaped up, we got the same of what we saw before. We saw weak bidding on the way up. We saw a pretty crap rally. We saw some sell off into the close of the session, right? Into the overnight session, with again a small relief rally coming up into today's open. So, what I'm looking at here is we can see prices rally just a bit, and I don't think that dead cat bounce or a bear market rally is out of the question, right? I'm not here to say, oh, okay, we're going to dump right now. But the Bulls really need to take this, whatever kind of rally they're going to get, whatever kind of rally they want, they need to take this today and they need to take it in the first like hour, 30 minutes of the session to actually get some real incentive to buy this. So right now, as I'm looking at it, there's a few key levels. You're looking at the 38.05s, for example, O7s. That is a key area. Also 37.90 495. If we can get a strong rally off the gate of today's session, then I think a lot of these rallies in and around those areas are going to be shortable for a pretty significant drop, right? So, what do we have today in terms of news? That's going to be important because we still have the Federal Reserve talking. We had since about last week, these guys have been just pumping and pumping testimonies, economic projections, all that stuff. So later this afternoon, again, Federal Reserve will talk about the stress test, the 2022 bank stress tests, which will be established under the Dodd-Frank regulations following the global financial crisis. So all 34 U.S. banks with over $1 billion in assets will be checked against a series of doomsday scenarios to ensure that their balance sheets withstand a hypothetical downturn. Hypothetical, which is probably something that we're going to witness. Now, what a perfect time to be doing a stress test, is what I'm saying. So, the result, which will be particularly focused on stress tests in the commercial real estate and corporate debt markets, um, amid growth fears and looming recession, meaning an economic spiral, may not be that hypothetical. So I just read that little excerpt. That is the importance of this because, yeah, okay, they're hypothetically stressing them, but realistically, we've seen a lot of these junk bonds, we've seen a lot of these bonds, we've seen a lot of the debt market really take a beat down. And I don't think this is going to be a hypothetical stress test. I think this is a real stress test to see what the extreme will be of the move, right? What will the extreme scenario, how will it play out in these equities? So we also have the first session of the two-day testimonial on Capitol Hill. Jerome Powell emphasized yesterday, right, which he started, that the central bank plans need to keep raising interest rates until it sees clear proof that inflation is slowing. So even if that means causing a recession, dum dum dum. So he's given the liberty to do so. And I think everyone is just waiting for the central bank to really cause a shockwave at this point. What he said is it's not our intent, or sorry, it's not our intent to have this outcome at all, but it's certainly a possibility. That's what he's told the Senate Banking Committee yesterday. He also said we are not trying to provoke and do not think that we will need to provoke a recession, but we do think that it's absolutely essential to bring down price pressures. And naturally, we saw a little downturn in the markets. We saw some sell off, and not like crazy sell off, but we saw the slow of bidding at least for that turnaround. Um, we also saw that Powell said the events of the last few months around the world would have made it more difficult for us to achieve what we want. He also then said, we've never said that it's going to be easy or straightforward. So it's expected, right? Like he's not necessarily um admitting to why a lot of this is happening, right? Why we have this $9 trillion balance sheet that's causing these recessionary pressures, why we had to have a 75 base point hike. He's still kind of beating around the bush, just as he did with quote unquote transitory inflation, right? Transitory. So, in terms of more on the stress test, the annual health checks dictate the required size of each bank's capital buffer, which actually means the extra cushion of capital that is set aside on top of the regulatory minimum needed to support whatever daily business activities there are in these banks. So The check also determines how much the lenders can return to shareholders in the form of share buybacks and dividends, which will be announced, I believe, later this month. And this year's test might actually be harder because of the economic baseline is actually healthier, apparently, while unemployment and the drop in GDP would make it feel a little more unstable in that sense. So it's a little trickier this time around. However, all banks are still expected to pass, but could be told to set aside more capital than they did last year. So what we've seen with that, right, we're still going to be keeping eyes on the Federal Reserve and Jerome Powell. We're still going to be taking a look at individual names and sector rotation, because one of the main things is that in terms of some of the sector rotation, we see that energy is actually taking a beat down right now. And there's a lot of outflows in energy. If you take a look at even XLE outflows, if you take a look at individual stocks, the order flow is starting to turn a little more bearish on those. And what I'd said multiple times before is that when energy actually takes that beat down, when energy takes that fall, that is when we could actually start thinking about, oh, things are starting to bottom out, right? We need to see energy nosedive and get crushed, just like the rest of the sectors. So I'm going to be watching today very, very closely. I know it is Thursday, tomorrow's Friday. We got a short week, and it's hard to open up like mega short positions into the weekend like that. But I'm going to be watching to see if we do fail through some of these resistance points in the first like 30 minutes, 40 minutes of the day, and to see how the reactive sellers come into this market. So it's going to be very important to navigate that. We also have Fed Chair Powell. We'll see how the fund flows have been reacting compared to breadth into the end of the week, because even with these rallies, if you're looking at breadth indicators are super weak as prices are attempting to climb day in and day out. So that's something to consider as well. And again, I'm going to lean a little more bearish today if we get that huge failure in the first 30 minutes of the day on the S&P. So keep eyes on 3794s and keep eyes on 3805 to '07. So I'm just remembering these numbers. And if those fail, right, in the first 30 minutes and you get massive reactive sell, look for a larger downside move. If we can accept above both of those, look for the 20s, right? 3820s, very viable target. If we really run, the 40 to 50, I think, is my daily target for today to see this quote unquote dead cat bounce. Then we're going to readjust the plan to see, okay, where can the short be initiated based on this next move? Was it a real buying? Was the volume actually heavier today, which it wasn't over the past 2 days? So with that being said, I hope everyone has an amazing trading day, and we'll see you guys in our room. So we're going to jump into the options room right now. We're jumping into the futures room as well, and we'll see you all there. Don't forget that we also have a masterclass on the website for futures and options, and check that out. So thank you all. I'll see you tomorrow, and have a great weekend if you're done today. So chat soon. Bye-bye.